record button here and get us live up on the closed Facebook group so we can let's see here.
So Dan, are we going to be live to all your millions of followers?
No, this is just going to the closed Facebook group. So this is a paid event. So only people who paid will actually have access to this. So we're going to be going live and on Facebook onto the closed Facebook group only. Does that make sense?
Makes sense to
So
me.
you can feel free to say whatever you want to say, and only a select number of people will hear it.
Oh, I don't know if that's good or bad.
There's only 500,000 on the live Facebook group.
Yeah. All right, so let me get this going here. Go live. All right, so we should be good with that. All right, so thank you guys so much for being here. This is going to be an exciting panel. I'm looking forward to this panel. Got a lot of good questions that are already here, and let me get rid of some of these questions here. Right, so we have a clean list of questions. So throughout the panel today, I want you guys to submit any questions that you guys might have with the panelists. So I have a list of questions that they've been given and provided beforehand, so they can review those. But I am also going to take some questions from the audience. And so let me pull this up real quick here. Saturday panel 1. So the first thing we're going to have you guys do is a lot of people don't really know who you are, and so I want you to first give us a 2 to 3 minute background about who you are, your background, kind of what I call the Reader's Digest version, and your experience in the multifamily investing arena, and then we will dive into the topic. So I'm going to call off your name, and then as I call your name, remember who you're going to be handing it off to. So you basically, when you're finished, you'll just basically say, all right, over to Dylan or whoever, and this is the next person after you. So we're going to start with Rob Beardsley, have him get us started first. You will turn it over to Sarah May, and then Sarah, you're going to turn it over to Dylan, and then Dylan, you're going to turn it over to Omar Khan, and then Omar Khan, you're going to turn it over to Corey Boatwright. Does that make sense? Everybody got that? And that's the general flow.
I turn it over to Dan after that.
yeah. So hopefully I'll be done cleaning this mess up by the time you're done. Right. So I will go ahead and turn it over to Rob, have you do some introductions of yourself and kind of get it going there.
Hey everybody, my name is Rob Beardsley. First off, thanks for everyone being with us on a Saturday. My background is I grew up in a real estate family, so I was always around I like to say that I was in diapers on construction sites. So that was my introduction, and then all throughout growing up, I was fascinated by numbers and the analysis side of things. So that's where I find myself today on this underwriting panel. And now full-time, I'm focused on large multifamily. Last year, my business partner and I founded Lone Star Capital Group, which is focused on Texas acquisitions. And I'll pass it off to Sarah.
Hey, thanks, Rob. So I'm Sarah May. I live in the Denver, Colorado area. And unlike Rob, I had no previous family real estate experience when I got started. I'm an aerospace engineer by training and was working for a large aerospace and defense company and decided, to start building up a real estate portfolio for passive income. So started with small multifamily properties, owned and managed them individually, and did that for a number of years with some success, and then learned about syndication and how to partner with people to essentially create a business and do more deals and help a lot of other people get into real estate who otherwise couldn't do so on their own. So founded Regency Investment Group a couple of years ago. We focus on B and C class properties in Colorado that we can add value. And I've also invested in a number of deals as a passive investor, so I can speak to that as well. I'll turn it over to Dylan for his introduction. Excited to be here today.
Awesome. Thanks, Sarah. Great stuff. All right, Dylan Marma, currently play investor relations and acquisitions with Rand Partners. We're based out of Knoxville, Tennessee. Many of you, if you're not familiar with Rand Partners, we're also the investment group behind Jake and Gino with the podcast, and we have our live events. So, I've been playing a big role in building up a platform of investors and working a lot alongside the investors and doing the asset management stuff. But today, more so, we're going to be focused on the acquisition side As we expand into new markets here in the Southeast, we've been really dialing in our systems and our processes for underwriting. So really excited to dive into that and share that with you guys here today. And my background, started off as in sales. I was actually the youngest sales manager with a real estate investment education group.
Please, इसको ले जाएं कमरे में.
What's that? Hold on.
We'll just,
okay.
I forgot to mention that when you're not speaking, just turn the mute button on your mics. So.
Okay, got it. Okay, just want to make sure. I thought there was a question. No. Yeah, so I was the youngest sales manager at Real Estate Investing Education Group. So I really got exposed to all different aspects and sectors of real estate investing. And then a lot of that led me back to multifamily syndication. I saw it as being, started off in single family, but quickly transitioned into this space as I saw it being the best vehicle, to create secure wealth over a long period of time. So that got me started, and I've been at this for about 18 months now, and just over the past few months, we have invested in about 300 units, so it's off to a solid start here. So, and without further ado, I want to introduce Omar.
Hey, Dylan. Oh, whoa. Hey, so I think I muted my mic a bit too much because I pressed all the buttons to mute. So thank you for that, guys. Thank you, Dan. Thank you, everybody, for being here. Before I begin, Sarah, I've got to ask you, either you've got a really good room or I need to figure out how you do your lighting because my lighting sucks.
I think that's just a fluke. I think I have some natural lighting and
yeah, I'll try to play with this the ring light that I have. Anyways, guys, my background's in finance. I did M&A and corporate finance for about over a decade in real estate and commodities. My family, similar to Rob's, my family, I wasn't on as many maybe construction sites, but my family owns a lot of strip malls, shopping centers, half-service motels and a couple of those kind of things. So I kind of grew up around these things. Just with my background in M&A and all of that, when I moved down to the U.S. A few years ago, we were basically looking for investments which were tax efficient, as well as where we had some level of control over. So real estate offered a good mix of both, and also it kind of helped that my background was managing money as well, so I could have somewhat of an easier move into the industry. Just leveraging off my background. I'm very excited to be here, and I'm looking forward to having an interesting conversation with everybody. Oh, by the way, over to Corey. I totally forgot.
Thanks, Omar. Appreciate it. Well, I appreciate having me on here, Dan, and hello, everyone. It's exciting to be on a panel like this. And my name is Corey Boatwright. I come from the single family space. Only in the last few years to really get involved with the multifamily space. Currently right now I have 424 doors under management and have some great partners that have got a lot more than that, and excited about syndication. Really interested in focusing on Oklahoma City, which is where I'm from, and kind of 30 miles from Oklahoma City, 30 miles from Tulsa. I think there's a kind of a hidden gem here. We don't have our hedge fund managed. We don't have hedge funds here yet, but I think they're coming. Run a single family wholesaling business. We do over 100 those a year. Have a great team in place for that. My two partners right now are Corey Peterson, known as the Big Kahuna. It's great little marketing, and Sean Terry from a company called Flip to Freedom. My company's Investment Capital Group, and coming from the education space as well, have a consulting business, that single family side, and the multifamily side is just something I think is just an amazing opportunity, even if especially if you're coming from the single family space, to build long-term wealth and legacy. So excited to be here and learn a lot.
Great. That is awesome. And in case you guys are worrying about me, I'm all clean. So we're good. Got it all cleaned up in the break. Had the cleaning crew come in, pit crew, fixed it all up for me. So we're ready to go. Thank you guys for your introductions. Really appreciate that. Really appreciate each one of you being here and sharing your knowledge and your expertise. We're going to get it started. And the title of this is, conservatively strategies for conservatively underwriting an apartment deal. So I want you to first start off by giving us what your definition is, because there's the definition of conservative and underwriting, I think, can be different based on different groups and what the criteria they're looking for and various things like that. So I want you to start us off by giving us what your definition of what a conservatively underwritten deal is for you or your group. And so we don't have to go in any particular order, but I do want everybody to have an opportunity to speak. So I will open it up to the panel and have you go ahead and answer that question one by one.
Sure. Okay. Just to keep it in the same order, I'll go ahead. So I think for the purposes of this discussion, we'll distinguish what is a conservative deal and then what is conservative underwriting, because a conservative deal is the metrics or the qualities of the deal itself and the business plan, but how to conservatively underwrite that deal is a bit different. So I'll try to stick to those points, and people can maybe chime in or take a differing view. So in my opinion, we'll keep it simple. So the rent growth assumptions, people will reference different information or data providers and say, well, this market is projected to have 5% rent growth in 2019 and then 4% rent growth in 2020. So we'll put that in our model and off we go. I think a conservatively underwritten deal is still going to have more constrained rent growth assumptions, as well matched with appropriate expense growth assumptions. And I'll add maybe one or two more things. I think one thing that I'm sure we'll be talking more about are the terminal cap rates or your exit cap, which determines your sale price. Obviously, if you're projecting to sell at double what you paid, it's gonna look like a great deal. So in order to keep that constrained, I think it's smart to assess what the market cap rate is for what your exit product will be, not your value add purchase product, but what your stabilized property will trade for on a stabilized cap rate basis now, and then go above 100 basis points from there, give or take. I'll pass it on to Sarah if we want to keep the same
Sure.
format.
Yeah, so I totally agree with Rob. I think the rent growth projections and the exit cap rate are two huge factors, and just a little bit of a change to those can dramatically influence the returns to investors. So, whether you're a passive or looking to sponsor a deal, I think those are two things to look at. The other two I wanted to add are property tax increases. A lot of times, brokers will try to get by the fact that property tax increases every 2 years. So just make sure in the underwriting that you take into account property taxes at the sale price, or else at least 80 to 90% of the sale price in the future. I think that's a conservative approach. And then the other thing that I think is a huge determination of being conservatively underwritten is whether the entire economic vacancy is included in the deal. So usually, if you look at a broker's OM, you'll see vacancy and it's around 5%. And, that could be realistic for physical vacancy and units that are empty. But then you have all these other terms like loss to lease and bad debt and concessions and model units. And usually in a deal, after you take all that into account, even in a good deal, that's closer to 10% or more. So just make sure that all those factors are included when looking at the deal, and then you'll be on your way to having a more conservatively underwritten deal. I'll go ahead and turn it over to Dylan.
Awesome. All great points so far. I'm still looking for a sponsor that aggressively underwrites. I've yet to find one. But when it comes to underwriting, I think you hit on a lot of the key points, right? The assumptions, the vacancy rate, the exit cap. I think those are three of the key points. So I want to try not to repeat those again. But I think one other thing to really add to that, which especially because most of us here are in the BNC, more the value add space. And a lot of the times when you're going in and you're doing a value add, especially if you're buying from, say, inexperienced operator that's had historically very low below market rents, there's going to be a lot of turnover, right? You're going to be charging a new rate for the rents. You're oftentimes going to be going in there and doing repositions and turning all the units, and you're going to be attracting a new tenant base. And in that process, you can't assume that the vacancy is just going to remain at 5% or 10%. So I especially in those first 6 to 18 to 24 months during takeover, depending on the size of the reposition that's taking place, definitely factoring in for a large loss of occupancy, right? I think a lot of people, they're underwriting, they use market rents on year one on their calculator, and then they're assuming that the rent's instantly going to pop up to whatever the market rent is, and then instantly that you know, the underwriting is no longer valid in terms of what the actual property is going to do, right? If you expect at the end of year one to get your rents to a certain point, then maybe your year one average is somewhere in the middle. Maybe it's somewhere closer to what the actuals were on the previous 12 months, right? And this is the level of thought that I think especially is important, and I really stress it to passive investors, right? Because a lot of times it is the sponsor's responsibility to go and underwrite these deals in an ethical way that's going to provide the passive investors with a reasonable you know, expectation on what to look at during their pro forma. But if the sponsor gets too caught up in hitting their IRR target, and then they start to, you know, incorporate all of these things that we're touching on here, and the passive investor is just trusting them in that, I think it's you know, it's definitely not serving anybody besides really the sponsor in that deal. So I think it's you know, really just stressing. I'd love to see more of that throughout the passive investor community. And the last thing I'll touch on when it comes to conservatively underwriting, I think one of the biggest risks that we run in multifamily real estate is your interest rate risk, especially if you have floating rates in place, because the way that oftentimes you're going to bust out during a market cycle is because your income goes down and your interest rate goes up at the same time, right? So if you're especially when you're evaluating a deal that incorporates a refinance during one of the early years, or if it's a deal that has floating rate debt on the deal, making sure that the assumptions on where the debt is going to be at the time of refinance or throughout the life cycle is reasonable and what you would consider to be conservative, because I think that is one of the biggest risks that we as investors take. And I think if you're investing into a deal that has bridge loan, that has floating rate debt, or that has a refinance, you should expect some level of premium return, you know, if the targets get hit, because you are taking on additional risk in place. And that's why a lot of our stuff is long-term fixed rate debt with, you know, long-term holds. So Omar, if you want to go ahead.
Sure. Thank you, Dylan. So those are some great points. Oh, sorry. Thank you. Thank you. Can you hear me? Yep. So all of those are great points. And I think, I mean, just to add to that, what Dylan said, number one, I think what's helped us is in our deals is that instead of taking aggregate average numbers over a period of time, what we kind of have is figure out a renovation plan by unit type. So, you know, studios are going to be having a different rent growth rate, 1 bedrooms, 2 bedrooms, and they all change by market. So it's not like they all grow at the same rate or they all have the same demand. So before going into a deal, if you look at everything on a unit by unit basis, and I understand if you have a 200 unit building, it can be quite a pain, but it's better to take that pain up front than to realize 12 months into this thing that, you know, the budget your property manager agreed with you, you're $100,000 off from that. And now you got to make your interest payments, right? So looking at things on a unit by unit basis. On the other thing also, what Dylan said on the fixed versus floating rate debt, on the institutional side, I can tell you that not a lot of folks use fixed rate debt. And the reason for that is very simple. Their hold rates aren't 3 to 5 years. I mean, their hold rates are 3 to 5 years. Now, for instance, if you're holding for 7, 10, 15 years, well, yeah, I think fixed rate is a very good debt. It's actually very smart debt. But if your hold periods are the average syndicator is 3 to 5 years, and if you bought a tight interest rate cap, you're not going to get penalized when you try to refinance typically in the years 2 and 3, because if you have fixed rate debt, agency debt, ideally, you're going to take either a massive hit if you refinance just with the prepayment penalties, or you'll have to add a supplemental. And then there's just a lot of things. So the big thing here is to match the type of financing product to the type of deal you have. Now, if you have to do a lot of repositioning, maybe, I'm not saying all the time, maybe floating is better debt. But if you don't have to do a lot of repositioning and it's just come in, do the bare minimum because it's already an efficiently run asset, not a lot of deferred maintenance, then you can maybe get the fixed interest rate. And just to top it all off, again, saying the unit by unit assessment thing, guys, we feel it's very important. When I joined, or rather when I started doing this, I realized practically nobody was doing it on the retail level, or rather at our syndicate level. And this can make you or break you. And to give you an example, we're doing a deal in Jacksonville where the studio rents are through the roof. In fact, in certain cases, we are renting studios for a higher rate than we are renting 1 bedrooms for. Now, that sounds counterintuitive, but if you don't know this stuff, you can have a really weird mixture of rents that have no bearing in reality. So over to Corey. I keep forgetting that, man.
Great points. I think everyone just touched on everything. Really not much to touch on. Rent growth, property tax increases, vacancy, occupancy assumption. On the occupancy assumption, We again have a team that kind of does all this underwriting. So this is not really the area that I'm spending the most time in. But one thing I'm noticing, even if it's 100% occupied, we never underwrite it as if it is. So we're always looking at, I think the highest around 94, 95% occupancy. And so we give ourselves a little bit of cushion there. Also, we don't ever assume that we're going to get a 30-year fixed rate, anything. We always assume that we're going to get a 25-year on our amortization. So just, always giving us a little bit of room there just in case that we need it is always a good thing. Never pushing everything all the way up to the line is some of the things that we follow.
All right. So next question. Thank you for that. That was a great dialogue back and forth. That was great. Going everybody kind of teeing up against the next person and agreeing back and forth there. So I like that a lot. I want you to do me a favor as we're getting started. And I know you guys have the copy of the questions, and I'm not sure if you have them in front of you, but I gave you guys a list of 5 things, I believe. 1, 2, 3, 4, 5. So we have entry cap rate, the exit cap rate, the cash on cash, IRR, and the rent projections. And so I want to go around and I want you guys to put those in order of importance of which ones you feel are more important than the other ones. Even though you might say they're all important depending on all this kind of stuff, I want you to kind of give me, if you can, an order of importance of those 5 different areas. And I will open it up to whoever wants to start. I know you kind of been going around the room, but it doesn't really matter the form. So if somebody else wants to get started first, you can do that as well.
All right, I guess I'll go. So I kind of said that rent projections were number 1. If your rent projections are way off, there's no recovering on your cash on cash or IRR. Next important, I said, was exit cap rate. I think that's a huge factor in how the deal looks. 3rd, IRR. And 4th, cash on cash. And then I put last as the entry cap rate, just because I've found with these value add deals, the entry cap rate is somewhat irrelevant if there's enough value add, both on raising rent, raising other income, and cutting expenses. I'm also in Denver, where it's a pretty low cap rate environment. And, if you sharpen the pencil enough, even these low cap rate deals can work. So I put that as the last important for me. Whoever else wants it.
Yeah, I'll go ahead.
Go ahead.
Go ahead. Okay, thanks. So this is definitely a tough question. I think depending on the business plan, I'll kind of I'll cheat a little bit and say they're all important. But the IRR and cash on cash, I think, are most important. And if it's a value add deal with significant upside, then the IRR is going to be more important, because the cash on cash will, of course, look not that attractive, because when you're repositioning a deal, the first year or 2 of cash flows won't be that impressive. So, but if it's a fairly stabilized property, like Omar mentioned, where it's not much deferred, you're just coming in, it's already well managed, then the cash on cash is going to be very important, because how can you argue to me that you're buying a stabilized deal that was managed by some institution that owns thousands of units, and you're going to get a 20 IRR by just running it and keep running it as is? So then my next points, I think rent projections, Sarah was on the money on that. Depending on your timeline, if you're only having maybe a 3-year business plan, or typically people underwrite on a 5-year timeline. But if people nowadays, I've seen 10 years, because people want to think longer term and buy a deal with fixed rate debt and ride it through the next economic cycle. If you have 3% rent growth compounded over 10 years, that's a very scary implication, because you're going to have some really high rents. And I don't think there's ever been a period in history where rents have only gone up for 10 years straight. So that would be number 2, after cash on cash and IRR being number 1. And then definitely exit cap, but in relation to your entry cap, which I'm sure we'll get into later.
All right, good stuff. I have almost identical as far as my order. I think a lot of us are probably pretty similar in thought process here. But I'd said IRR is number one. I think, just to stress, I think it's important to take a 360-degree view of the deal, because you're really balancing what the opportunity is in place versus what all the risks are. IRR is different than where it differs than cash on cash, especially. I know a lot of people nowadays are making cash on cash during the holding period, and then they also will do cash on cash, including the proceeds at sale, right? So it's important when you're talking cash on cash, I think, to specify which one we're talking about. I think in this context, we're talking about during the holding period, what the average cash on cash will be. The reason IRR, usually is a better example than cash on cash to give you a comparison between investments can be because it also factors in the timing of the distribution. So you can factor in if you do a refinance early on, or when you're receiving the capital back, you'll usually have a stronger IRR if more of it's received on the front end versus the majority of it's received in the back end, considering all else remains the same. And then from there, you have rent projections, you have exit cap, and then you have entry cap in order. I think it's really hard to give these all in order because they all play to each other. But I think if we're just assuming that the assumptions are all accurate and in position, I think it makes sense to evaluate a deal using it in that order. So that's all I got.
I can take that now. Thank you, Dylan. Guys, to Rob's point, I think a lot of this depends on the project you're dealing with, and not necessarily, hey, here's a cookie cutter list and check a box. But in the value add space, BC space, guys, most of us are playing in the sub-institutional space. We're not going against the BlackRocks or the Apollos. I kind of have to agree with Sarah. In terms of like the numbering of the factors, rent projections would be number one. But again, to Rob's point, trees don't grow to the sky forever. So if you have a 3% average rent increase, or even a 2.5% over 10 years, that's a weird number. Anybody can look like a genius doing that. Then I would say the exit cap rate, primarily because 99.9% of any deals you will look at, they are so highly sensitized to the terminal value calculation, which is the exit cap rate, that practically you can have a real stinker. And if you just put the right exit cap rate, everything, you just start looking like a genius again. Then I would come to cash on cash, and I would put IRR and entry cap rates both as, I guess, the last options, because I was trying to see which one I feel matters the least, and I feel both of them matter the least. And the reason for that is very simple, to me at least. This is just my opinion. Number one, look, I personally like the IRR because, look, it's a good calculation, all of that, but it's so highly sensitized to when you pay the money and what amount of cash you return to somebody. So for instance, you can have scenarios where somebody is paying you, say, every quarter for 2 years, and some guy pays you at the end of the 2 years, but a higher lump sum money, and they'll both have the same IRR, even though in the real world, you'd probably go for a guy who keeps paying you quarterly. That's just as a safety mechanism, right? And the entry cap rate, again, to Sarah's point, the types of assets that most of us are trying to buy, there has to be a clear story. It's either mismanaged or performing under market. So therefore, the entry cap rate is kind of, to me at least, a useless measure, because the reason is very simple, guys. No matter what somebody tells you, what some guru tells you, regardless of what happens in the market, 9 times out of 10, if you're buying an asset, it's not based on the income valuation. So nobody goes NOI divided by the market value. Right? Nobody is valuing assets like that. What people value is, hey, what did the guy down the street buy it for? Now, it could turn out that the guy down the street who bought it was a complete idiot, but now that's the market price, and that's what you got to pay. So your entry cap rate could be so low, but still, looking at that in isolation, because I do feel a lot of people look at that, I think it's as useless as an IRR, without looking at the entire context of what you're trying to do. Over to Corey. Didn't forget you this time.
Yeah. Great, Omar. Again, everything's covered on here. I think from what I've seen so far, what I would put as the most important is IRR is one of the most important. Interesting thing about that on raising capital is that's a great question to ask. Where do you need to be on your IRR? And sometimes that's actually a better question to ask than just telling what your split is in the beginning. So I see people kind of make that. I feel like that's a little bit of a mistake in the beginning. Finding out really where they need to be and kind of working from there is actually, I think, a better way to approach that. So the IRR in terms of with the investors seems to be a very big sensitive point from what I've seen. And rent projections, I think obviously that's really important. Probably one, maybe even more important than the IRR. They're really close. cash on cash, and then exit cap and entry cap. I think on the entry cap being the last, people get caught up in these cap rates, but at the end of the day, it really comes down to what's this deal look like? What's cash is coming in on it right now? Don't get caught up on the cap rates. It can be very deceiving. And, you can manipulate a lot of different things by fixing the bad tenants and fixing the bad stuff.
So it sounds to me like exit cap rate is very important in your projections as you're putting together a deal and underwriting a deal and seeing if it's one you're going to, be attracted to. So let's go around and ask that question as well. What kind of strategy do you guys have in place for projecting that exit cap rate, and why?
Sure. So I'm seeing a lot of questions in the chat box about this too. So it's a hot topic, and a very good point here in the chat box as well is the way you would approach your terminal cap rate depending on the deal. And I think we briefly touched on this earlier, but more specifically, most of us, like Omar said, are in the value add BC space. And what that means, as you may have heard now, is we're purchasing properties with a compressed cap rate. The property has higher vacancy, under market rents, and maybe for a clean product in this market, you could buy it at a 6 cap, but because it has value, meat on the bone, you're paying a 5 cap with the hopes of renovating units, implementing your value add business plan, and then operating it at a 7 cap. So when we're talking about purchasing at a 5 cap and then determining what your terminal exit cap should be, saying 100 basis points above 5% being 6% is conservative, I would definitely disagree with you, because I would say when you're selling this product, you're selling it as a stabilized asset, not a value add asset, unless the market's grown tremendously, incomes have grown tremendously, and now you're selling it as a new value add all over again, and someone's going to put granite on top of your newly resurfaced countertops. But so if the market cap is 6%, but you paid 5%, you would need to actually spread to 7% in order to have a conservative 100 basis point spread between your entry and exit. So that would be my point there. I'll pass it on to anyone who wants to chime in.
Yeah, I'd agree with Rob's point. I think a lot of this is dependent on where your market rates are. Because look, at the end of the day, think about it this way. The buyer who's going to buy a property or any asset from you, they don't really care what price you bought it at, right? What they care is what is the current market price, right? Because that's how they're valuing their decisions. Similar to us, right? When we go buy something, now it doesn't matter to us if somebody paid 3 times the money, because what we're going to do is figure out a way, hey, is this a fair price given where we are in this market right now? So having like just a general rule of thumb, say 100 basis, 75 basis points. I think that would work if you were only buying in market. Like, so if the market, bad example, but the market cap rate is say 5.5%, and you bought exactly at 5.5 or like 5.45, some version of that, then yeah, you could go ahead and say, hey, it's 100 basis points. But that's also dependent on the fact that, look, do you live in a growing economy or do you not live in a growing economy? If you live in Mississippi, you might have more stability in your valuations versus, say, somebody who lives in a cyclical economy like, say, Houston or El Paso, right? Because when the market's good, it's really good. And when the market's bad, I mean, you can have the best asset in the world and you're just swimming upstream. So I think a lot of this is dependent on your market. And a lot of this is also dependent on basically kind of understanding what the market, where you are versus the market at each moment in time. That's how it kind of helps you figure out. Again, is there like a magic pill? If there was, we'd all be very rich and probably wouldn't be on this panel right now. But there isn't. It's all dependent on the market, and it depends how you're running the asset versus what your competition is doing.
I'll just add one other thing. One way that I like to look at it, and I'll credit my mentor, Brad Semrock, with this idea, is using historical market data to project the exit cap rate. Services like CoStar and Yardi Matrix, they actually have reports where they've tracked the cap rates in different markets over time. And you can get a copy of these reports and see what the cap rate's been historically and use that number in your projections. So across the US right now, we're in a abnormally low cap rate environment in multifamily. So in Denver, where it's 5.5 cap rate right now for a stabilized value add deal, maybe, historically it's more like 6.25 cap rate. So in my underwriting, I would use 6.25 as the exit cap rate. Other markets, secondary and tertiary markets, you'll usually see a lot higher numbers, 7% cap rates plus historically, and you can use those numbers in the underwriting to show conservatism, even if right now that tertiary market's trading at below a 6 cap. Historically, it may be at a 7.5. So market data is great if you can get your hands on it.
Yeah, I agree with that. I think the market data is perfect with CoStar, one of the best places you can get that data. The other thing is it's really looking at the class of the projects. I mean, we're actually looking at now many things that are just B and up. C class, often, you can get some great opportunities there, but you're also going to have to really look at gentrification. You have to look at what's going on in the area. No matter kind of how you dress up a pig, is it still going to be a pig? So just really looking at more of just a holistic and also another view of that class of area and what's going to really happen. Are the airports being renovated? Are the things going on around the area that are really going to bring up the area? Or, are you just kind of looking at this opportunity right now to get a property and fix it up and hope that your rents are going to increase, and hope that, building a business on hope is not a really smart thing to do. And I see a lot of people that get into these, 9, 10 cap, 11 cap things in the Midwest and the South that you could actually find still some of those deals. But, it's a C class property, and you're just buying potentially a lot of challenges with it. So it doesn't mean that you can't turn those around, especially if there's a great opportunity, but you definitely need to look at what's going to happen in the future. Essentially, when you're in the business anyway, you got to be looking at what's going to be happening in the future. Make your best guesses from there.
Yeah, I mean, you guys are definitely nailing it. You pretty much hit on all the key points. I would definitely just second what Omar said about the markets too, and looking at looking at the historical market data for caps, but also looking at is it a linear or a cyclical market, because it's going to give you just a better understanding, right? Because some of the markets that we underwrite in are just really cash flow markets, right? They are more just your workforce housing markets. But if you're investing in a high growth market, you're going to see usually a much larger fluctuation in caps throughout different market cycles. So I would definitely, again, confirm that CoStar, Yardi Matrix, and then also a lot of brokerages will send out a lot of really, really good market data. So if you're looking at deals and you're practicing your underwriting, make sure you're getting the Marcus Millichap reports, make sure you're getting the Bracadia reports, make sure that you're on every major CBRE's got a lot of good stuff. Make sure you're plugged in, even if you just Google and type in CBRE Q1 PDF, right? Usually every quarter or every season they're releasing different reports. So it's just important to save those, collect those, and use that data to help you make better decisions when it comes to evaluating your exit cap.
Well, Omar, I want to turn it over to you because I know there was a question that came through about rent control and how to kind of bake that into your underwriting. So some of these questions that'll come through, I'll kind of select on somebody, and if anybody else wants to expound upon it, they can. But Omar, I'm going to put you on the spot and have you answer that one for us.
Look, I think I answered this on the Q&A. We primarily are not specifically looking at assets that have rent control. The reason is very simple. I lived in Toronto. We have rent controls there. And a big reason why I actually wanted to invest in Texas and Florida is because we don't have any rent controls. I want to be the master of my own destiny. I don't want somebody else telling me what to do with the asset that I have paid or my investors have paid their hard-earned money with. But that being said, every asset we buy, we mentioned the past couple of ones we buy, we realize there's 1 or 2 Section 8 tenants. I know that's not the exact same thing. So there's some level of that, but we tend to avoid markets where there's rent controls, because usually what happens is there's also market which don't have investor-friendly laws. You can't, if your tenant doesn't pay you, it might take you forever to, evict your tenant and all that stuff. And we just don't want that kind of hassle. I'll just be honest with you. Not saying it's a bad strategy. That's just not a good fit for our business model.
Good answer. Anybody else want to add in there about the rent control? Anybody?
Sure, I'll chime in. So here in Silicon Valley, there's some scary things happening, but some wonderful things happening. There's I'm hearing metrics like there's 24,000 new highly paid employees coming here every year, but we're really only creating 2,400 housing units. So there's a major imbalance, and you can agree or disagree, but some governments feel that they don't quite understand supply and demand. So they think, let's just kill the supply and then make rent control. But anyway, point is, being from this area, we feel very confident, not saying we invest here, but we understand this market. We feel very confident that rent will continue to go up. And it actually makes underwriting rent growth fairly easy, because if Mountain View says, hey, you can't raise rent any more than 3 or 4%. Well, I can say with confidence, rent will go up 3 to 4% every year in a strong market like this. So definitely not an expert in underwriting in rent control markets, but it would make me feel comfortable more on the rent growth, just because the demand is so huge typically in these rent controlled markets.
Anybody else want to chime in on that?
Yeah, I'd just like to take that. I think Rob's raised actually a good point, which a lot of people, I actually didn't say it properly. Guys, I know, including me, we all really crap on, California and this and that. But let's be honest, guys. California is the 5th largest economy on the planet. Not in the country, 5th largest on the planet. So something's obviously happening. Okay, now if you and I don't get it, it doesn't mean it's not happening. It's happening. So investing in some of these markets, like even New York as an example, there's a reason why a lot of rich people live in New York. Something's happening. So just because it's not a good fit for our business model, as an example, or the way we operate, doesn't necessarily mean it's not a good strategy. Because it could still be a great strategy, but there's only so many things one can do at a given moment in time.
Well, I'll just kind of dovetail with this on a kind of a segue point on, I think a lot of times when people are underwriting a deal and looking at a deal, and then they lose a deal because somebody else outbid them, and they look at that and they go, there is no way that anybody in their right mind can underwrite a deal and pay that kind of price for it and make it work. But a lot of times what we don't realize is that they don't play. A lot of times they're not playing in the same business model that we are. They're not necessarily having to do some splits from the GP side and doing a syndication model. They might be buying the property themselves, and they just want to, preserve capital and get the depreciation and various things like that too. So we have to kind of look at that from a different business perspective and a different business model perspective. And yes, it wouldn't make sense from a syndication model, if you will, but maybe in a different type of a business model within, multifamily, it might actually work. So let's do this. Let's go around and talk about the various strategies you guys are using right now in your underwriting for GP splits. So we're talking about those general partner splits in a syndication model, and also some of the promote fees, but also the promotes, but also the fees that are included in there as well.
Yeah, I'll come in on this one just because again, this is an area that we're learning a lot more about. My partners have a lot more experience than I have in it, but on the last 2 deals that we did and we raised money on the syndication, we actually did a 6 and 6. An interesting thing about that was, there's a lot of different ways, obviously, to split up these GP splits, but this one was interesting because we did a 506B, I believe. Yeah, 506B, where we had 35 sophisticated unaccredited, and we have unlimited accredited. And that's kind of that friends and family money. A lot of people do, and we still had a PPM and everything in place. But what was interesting is we had a cutoff. So that was interesting because whenever the investor comes in, he has a ceiling essentially of where they are, and then they get no more. So 6% a year for 5 years, and then another 6% kicker at the end whenever we sell the asset. So a total essentially of 60% over that 5 years. And we sold that twice on these 2 deals. So you get to keep a lot more of essentially of the deal, but it is a little bit harder because you start to have kind of run out of the friends and family and all these other opportunities. It's great because a lot of people that put the money in is from qualified funds, and so they're not making much money where their money is now. So double-digit returns, of course, for them is great. On the other side of it too, you have other investors that kind of look at other options. So they don't just have your option; they have other options, and so those aren't typically the people that we're really targeting. We found that whenever we call it kind of risky money per se, when the IRRs are 18 to 21% or something. We kind of look at that as risky money, but on these last 2 deals, doing the 6 and 6 was definitely a learning experience. We're looking at another deal, working with Michael Blanc right now, raising some cash on. That's a different split. But what it comes down to is really understanding who you're going after and really where they want to feel comfortable on their IRR. And what we found is many people are just, a lot more aggressive, if they want those obviously higher IRRs, but don't just assume immediately that someone wants to have a 16 to 19% IRR or 20% IRR. Don't just assume that. They may actually be completely happy with having a 12, 14, 14% IRR and be perfectly happy with it. So those are some of the thoughts I have on it.
All right, I guess I'll go. So the way our group typically structures deals is a straight split. So this keeps things easily transparent for everybody involved. I would say that's the major benefit of doing a straight split. And what I mean by that is all sources of cash flow and then the back end payout is split to a certain percentage. So what we usually do is 80% to the investors, 20% to the general partnership. And just every dollar gets split that way with the group. And there's some caveats, like cash flow is actually return of equity, so it bumps the sponsor compensation a bit. But in general, it's super simple. Just divide every dollar by the pre-agreed amount. And, I think it also aligns interests very well, since the GP is always trying to make that next dollar because they get 20%. So I like that about it. And then I guess on fees and things, we're pretty light on the fees, 1% acquisition fee, 1.5% asset management fee, and no sort of exit fees, construction management fees, or anything else that you could come up with. So it's pretty simple the way our group does it. And I don't know if anybody does a pref, but maybe they would want to talk about that.
I'll go next. So with us, I think everything could be a little bit different depending on the deal, but you're going to be relatively in the same ballpark. So I'll just go over the numbers, what they looked like on our last offering. So we did a 3% acquisition fee. We did a 1.25% of gross collected rents as the asset management fee, no refinance fee, no disposition fee, no construction fee. And then we did do a pref. So we did a preferred return of 8%. Then we have a catch-up provision to where the general partners would receive their share above that. And we do a 70-30 split of all of the cash flows and the gain at sale. And the cash flows do count as a return on investment, not of investment. That pretty much sums that up. Yeah.
Yeah, I can take the next one. So yeah, somewhat similar. I think it's a 8% pref. We personally feel any pref and then a split of profits on top of that with a catch-up is a more institutionally aligned model. It's better for the investors relative to just straight splits. We feel a straight split is misaligning interests between sponsors and investors, because essentially it's a case of heads I win, tails you lose. Because essentially, if somebody's investing money with me, I have to perform over and above a certain benchmark. And by I mean I can speak for a lot of folks, and Rob does it the same way, right? Like, we have to perform above a certain benchmark before we even start getting compensated. So to start getting compensated from the first cent that comes in through the door, as in remaining cash flow, I feel it's egregious. I don't feel it's right. And I also feel like, then why are we doing this? Why not just go to a typical REIT, have liquidity in your portfolio all the time so you can sell whenever you want, all that kind of stuff, and get the typical 6 to 7% distributions. And it's a more diversified, better portfolio managed by institutions. So you kind of get that, right? So for us, typically it's 8% preferred, 70-30 split with a catch-up, similar to what Dylan said. Fees on the front end are 2% of acquisition fees, and it's a 2% asset management fee that's very industry standard. But again, there's many ways to skin this cat. So it all depends on what you're doing, what you feel is the best interest of your investors, and what you feel even is a better model, because everybody has a different opinion on what a better model is.
Yeah, Omar, I'll just talk to yours. I agree that it's definitely more institutionally aligned to do the pref. I also personally like it in some respects because typically, if you run the numbers, investors get more of the cash flow up front, but then sponsors get more on the back end. So from a net payday perspective as a deal sponsor, sometimes it works to your advantage if you have a home run deal to do the pref rate. But for our group, the way we usually raise money is a lot of smaller investors. So we target the everyday investor, people who have 50 to 100,000 they want to invest. They like real estate, but don't necessarily know everything about it. And talking, prefs and catch-up payments and everything else, just it confuses them, and so they don't take action. So by just having a simple way of explaining it in our model, that's what works best. But totally agree with all the other points you made. I think it just depends on the deal and the investors that you're working with.
Omar and Dylan, do you guys want to go more in depth on the catch-up for those that don't understand that?
Yeah,
that's a great point. I was going to ask somebody to do that.
I can take that, and then Dylan can also chime in. Actually, we should both do it. Catch up essentially means, guys, that let's assume, let's assume me and Dylan are doing a deal together, right? We're sponsors, right? And you are our investor, right? So we say, hey guys, we're going to give you an 8% preferred. What 8% preferred essentially means is that, well, doesn't mean this, so you should check your legal contract. But usually what it means is that, hey, till you as an investor don't get 8% preferred returns, and depending on, if you do it quarterly, but let's assume we do it annually, right? Till you don't get 8% of your return back, I don't make a dime from profits. Essentially, me and Dylan don't make a dime from profits. But what happens after that is, if our split is, say, 80-20, right? Which means that you get 8%. After that, once you hit your 8%, after that, all the money that comes in, I have to hit my 2%, right? So I have to catch up with you, quote unquote. And then all the money we have after that will split 80-20, right? So what it does for you as an investor is that it makes sure that me and Dylan have to do we have to perform at a base level. But what it does on the counter side, what the catch-up does for us as sponsors is to say, look, if we perform up to a bare minimum level that we have agreed, after that, we will be made whole. So it's nobody's getting left behind because we serve your interests first. After that, we are made whole. And then after that, we split money in a manner which is what we've decided, 80-20, 70-30, whatever it is.
Right. And just to add to that, because just to Sarah's point, right, it's important to make this as simple as possible, right? Yeah. Because we have a lot of less sophisticated investors that will invest in the deal. So the way I try to break it down is that if we hit the target, because we are typically aiming for maybe a 15% target or so, if we're able to hit our targets, then all in all, between the cash flows and the profits at the sale, it should be split 70-30 after the initial principal's return back to the investors, right? But what the preferred return does is it gives them the certainty that first 8% of cash flows goes into their pocket. So just in example purposes, right, if the deal only did 8% between the cash flows and the sale of the property, they're going to get every single penny before we receive any promote, right? So it protects their downside, but at the same time, it also makes it should even out to an even split as long as you're hitting your target mark.
And the whole point is, look, most times, at least this is from my experience, because I know a couple of these guys, the returns that, for instance, you see on, for instance, any of the last deal that Dylan did, was it Louisville, Kentucky, right?
Yes.
Right?
Yep.
Yeah, for instance, so if you open or if you open our, say, deal deck for Jacksonville, for Rob's in Houston, you'll see like a certain number of IRR, cash on cash is promised. Now, net from my experience, that's net of all fees, net of, hey, whatever comes to me, whatever goes to anybody else. So you are still expected as an investor to hit that number. Now, how the split happens, yeah, you should ask questions about that. But as a sponsor, you are still being held to the level you have promised. So it doesn't matter how I split the money as long as you get what you have been promised. So keep that in mind as a contextual point of view.
Last quick point, I think this is an interesting discussion. Some people say that having a pref, and this is kind of playing devil's advocate because I am a pref proponent, some say having a pref incentivizes the sponsor to take undue risk, because if the sponsor isn't being paid until they achieve a certain hurdle rate, well, what does the sponsor want to do? They want to get paid, so they want to take more risk to potentially achieve higher return. And so I think that argument is very valid. How they go about taking more risk is less clear. Well, and maybe LPs should definitely do their homework to find out what that is that they may be doing to go and achieve that a higher return. So then the next question is, so first, do people agree with that point, or what's their take? And then the next question is, with this lower return environment that we're currently in, should we be considering a lower pref? Still having a pref because it's a great mechanism, but to keep things in reality, should our prefs now be lower, 7, 6?
Rob,
Or
I want
is
a
that
0% pref, but that's not happening. I know you want it too, but that's not happening.
Yep.
I'll speak a little bit to this. Again, this is the last 2 deals that we did. I mean, we had, it all comes down to, again, what kind of, who you're dealing with. I think someone said that on there, and your audience who you're dealing with. Don't assume that everybody wants these extremely high IRRs or what we would consider even an average IRR. It really comes down to where they are and what they feel comfortable on. I think we can all agree that the cheaper that we pay for capital, if we don't have it there, that, you know, at the end of the day, that's going to be more money that's made, cash flow before taxes. But I think that to speak on Rob's point on lower the pref, there was a time before this last deal that we did that we're paying an 8 pref. This other time now we actually pay a 6 pref and have that kicker at the end. So on the way that worked, obviously it was 6% pref for a 5-year hold, and then 6% at the end on the sale of the property, they get another 6% for every year. So essentially 12% for every year. And then some people said, well, that's maybe not enough IRR. You could actually always have an percentage upside after the equity hurdle. And so that would just be for whatever whatever dollar amount of profits made from there, you could give X amount of dollars that would typically go to the sponsor, dollar for dollar, depending on that split, could be given over to that investor. And again, this side of things gets a little bit more sophisticated than what I typically deal in. But I know that for us, with the pref being lower, we still have been able to raise money. And a lot of folks just say, how can you raise money at 6% pref and a 6% kicker? Essentially, there's a cutoff for the investor every year at 12%. Well, there are some ways that you can be creative with it and still not, have any kind of violation on your PPM or whatnot. It just comes down again to however you are setting up the deal and what you need to raise and who involved in that deal. Also say one of the things that's most important for us is protect investor capital at all costs. Protect investor capital at all costs. We treat the money that comes in as if it was our grandma that loaned us that money. I'm sure that you guys feel the same way. I mean, very important on how you're treating that capital. And so because of that, this particular model that we're looking at, it wouldn't typically work on these unstabilized deals where you have to refinance out in a year and a half or 2 years or 3 years. So we look at these momentum plays for a longer hold, 10-year, sometimes 15-year money off. Almost 95% of the time, it's already cash flowing right out of the gate. And typically a lot of our deals are coming from off market. They're not coming from brokers. So we're having to go actually to find the owner operators from our marketing tactics to find those type of deals. So again, Rob, I think it's a valid point that you start looking at the other opportunities on paying that lower pref if that is something that it's important.
So on the one of this topic of entry and exit and splits and stuff like that, do you guys ever have any secondary hurdles in like a waterfall structure where when you have that first 8% pref, and then once you maybe hit the 18% IRR targets that you might change the GP splits? Do you guys do any of that in your underwriting?
Yeah, I mean, it's pretty easy to do. If you can do one, you can do the other. I mean, if you have one hurdle, modeling the next hurdle after that it's literally the same way as you model the first hurdle. It's not really that hard to do.
Where do you typically set that secondary hurdle?
Look, to be honest with you, that depends. Corey was saying, and I think what Sarah also said, a lot of this also depends on your investors. Okay, so typically we've done a 70-30 split. Now, to be honest with you, why we've done a 70-30 split is I can go into every sort of sophisticated technical reason, but there's 2 very specific reasons. Number one reason is it's very easy to market because most of our competition is doing it. So nobody can then hold this against you. And number 2, it makes it a very easy, simple conversation to say 8% pref, catch up, 70-30 split after. That's it. Otherwise, if you say, 70-30 till 15, 80-60-40 from 15 to 20, 50-50 from 20 onward, I mean, that thing is going to take you 10 minutes to explain to somebody. But that being said, I'll be honest with you, I've had certain cases where I have a bigger investor coming in through the door. Some guys bringing in $3, $4, $5 million. That's happened on one deal, right? They are a more sophisticated investor. They know where to push. So they can, for instance, in that negotiation, for instance, they say, hey, charge me less asset management fee or charge me less of an asset acquisition fee. Then on the back end, I can say, okay, then I'm going to have this more detailed waterfall. And the waterfall might not just be on IRR. It might be on, say, a return on investment. It might be on whatever hurdle that we have decided, or an equity multiple hurdle, some version of that. But those are conversations that you can get in with more sophisticated investors that are not your typical $25,000, $50,000, $100,000 investor.
Any other thoughts on that?
Question to the group that I think would be. I just want to hear some thoughts on it. What is anybody doing? Any kind of side deals from your cut of the from you as a sponsor and the GP, where someone says, well, I know you're raising $2 million and you're probably going to get 10 other investors in here, but I'll send in $750,000 or $1 million of it, but I want to cut of from a side deal. Have you been hit with that? If you have, how have you dealt with it?
Yeah, most guys have been hit with that because he who pays the piper gets to call the tune, my friend. If somebody pays you more money, you got to dance for them, right? I mean, that's just the way it is. It's a harsh reality. So let's suppose if me and Rob decide tomorrow we're going to do a deal in Houston because Rob's a nice guy, right? And I like him, right? And we're doing a deal and we want to raise, say, $20 million. And some guy says, look, I'm going to take all this pain off your shoulders. And I'm going to bring $15 million. Well, yeah, they bought $15 million. They get to have the ability to negotiate. But if you bought $25,000, $50,000, I mean, what kind of negotiation are you going to do, man? It's just the way it is.
Yeah, and I would say that it's definitely something that we've had a lot of people reach out about. We have yet to do it, but if the right deal came up and is a large enough raise, it does make your life a little bit easier. So it definitely it makes sense to do it, right? Because it just instead of managing 20 guys that invested 50,000, you're managing one guy that invested $1 million, which makes your life much easier, right? So I think it again can definitely be worth it in the right situations, especially if you're doing, say, a fund, for instance, where you're raising a large amount of capital. There's also the option of doing, for a fund, I've seen it done with the tiered preferred return, where if you invest 250 instead of 50 or 100, maybe you're getting 9% preferred return, or 500, you get a 10% preferred return. And I really think that's an attractive model if you're raising for a larger fund.
Yeah.
Yeah, those are good points. And then going back to Omar's point, bringing capital at scale definitely brings you the ability to negotiate. And on our side, on the sponsor side, I think it's an interesting conversation because how is your firm set up? Are you set up as a capital raising company, or are you a real estate company? And so for the sponsors that just want to do deals and don't really care about necessarily getting as many fees or milking each individual investor, they may be more open to bringing a bigger investor, saying, okay, we'll just bring 90% of the check and we'll bring in the 10% and that'll make my life simple. Or some firms are set up very much so as a capital raising platform where they gain a lot of value from dealing with, and I say dealing kindly, dealing with $25,000 checks, $50,000 checks, less sophisticated investors, and really having a comprehensive investor relations platform. And then last point, devil's advocate, you don't realize, you think an investor that is sophisticated, like Omar said, he's going to bring you $15 million. What a great solution. I've seen that could be a humongous headache. We have dealt with big investors that want to bring in $3, $5, $10 million. And you think, oh, I'm so excited. This is going to make my life so easy. All of a sudden you're on the phone with them for hours. You're putting together special due diligence questionnaires, and there's all these things, and you're thinking, man, I would just love to raise from 100 people 50,000 each. So it's never easy. There's no cheat code.
Well, and I think one of the other things alongside of somebody bringing one big check too that you have to think about is the risk of getting down to a week or two before closing, and then they pull out, and then you got to raise the rest of that money in a very short period of time, which I think is probably the biggest risk and the biggest reason why I don't like that is because of that. Can one of you define what a waterfall is? Because I know that people are listening and that someone's already put on the chat box. What is a waterfall? I mean, obviously we know what Niagara Falls is, but what is a waterfall as it relates to underwriting here?
Sure. So a waterfall, if you want to look at it visually, is if we have NOI, then we pay our debt service, and then maybe there's some fees, and now we have free cash flow available for distribution. And from there, it can waterfall to the different members of ownership. So like Dylan mentioned, I actually really like this scenario where a fund is offering, $50,000 as a regular investment, but if you invest $250 or $500, you get a different class, you get better pref or better splits. So this waterfall means the cash will go to these different buckets, potentially, if there's a pref structure. And so most commonly seen is the 8% pref to Class A members, and that will be the LPs. And so after this waterfall will fill the bucket of the limited partner Class A members until it meets the bucket's filled to 8%. Now it can begin to overflow and fill the bucket of the catch-up, like Omar mentioned, which will get the GP there 2%. And then this bucket's overflowed, and the waterfall will continue down now to split evenly to the different members. And that waterfall can be as simple as that, if you thought that was simple, or it could be many times more complex.
No, I think that was a great explanation. I hadn't actually heard it explained that way, but that's a very good explanation of kind of thinking of it as buckets. And once it fills up, it kind of overflows to the next bucket, who's the next person in line for that. The next thing I want to kind of go over here is a discussion that somebody has put onto the Q&A box here about. Obviously, we can discuss, profit splits between GP and LP, but have any of you guys actually thought through the scenario of possibly in the future, having a capital call with your investors and how that type of a relationship would actually occur?
Well, I just answered that question, Dan, so I think I can answer that right now. Number one, look, that is always a possibility. That's why, we say all the time, this is where your due diligence as an investor comes into play on the sponsor. Because guys, at the end of the day, you have to realize you have worked, me as well, because I invest in people's projects. We have worked really hard for our money. Okay, we could have done a lot of things with the money, but we chose to save it and invest it so that in the future we can have a better quality of life, take care of our families, invest in our communities and all that stuff. So this is where, just looking at a fancy marketing presentation, any of that stuff, you gotta have to realize anybody can go on Upwork or hire a designer now and make something look really professional. Okay, so you got to do your due diligence, not just on the sponsor or the asset in terms of, hey, is this asset in a good market? Is this a nice asset? In terms of the sponsor, on the software end of the thing, hey, what kind of person is the sponsor? What is their experience been like? How do they react under, tense situations? Because when everybody's making money, everybody's happy. But what we really find out about people is when people are not making money. And this is why, to our earlier point, I said about the preferred structure is, guys, this is where we personally feel the preferred structure is a better. Again, there is no 100% great structure, okay? But preferred is slightly better than straight profit splits is very simple. Because in a capital call scenario, as a sponsor, I have to return you more money before I even come up to my, end of the catch-up. So if I do a capital call, I have to return you even more money. So I have to pay you back even more till I start making some money. So this is where if you start spinning profit splits from day one, what starts happening is there is no return of capital scenario there. Right? Because, if you put in whatever money, every dime we make after that, we're still splitting straight up. So this is where the preferreds and all of these other things, they sound hard. They might make your life a little more difficult because it takes half an hour to maybe understand them initially. But that's where they come into play, because these are a system of checks and balances so that no one party just goes crazy.
I'd love to bounce off that, because that's a really, really good point. With the preferred returns, we're constantly evaluating what we owe the investors on a monthly basis, and that is cumulative. So if you don't hit it one month, it gets pushed into the next month and all the way up until the sale of the property, right? So you're constantly accumulating that if you're not hitting that on a monthly and quarterly basis on the preferred returns. So with the capital call, we've actually had this conversation internally with our team over the past week, right? The last deal we've done, we have a couple $100,000 sitting in a improvement CapEx budget. budget that we're paying an 8% preferred return on, right? So the money essentially is sitting in a, collecting a little bit of interest, but again, we can only do so much with that. And until that money is invested, we're still accumulating 8% that we owe to the investors on that account. So I think when it comes to a more complex project, if we have a larger CapEx and improvement fund, next time around, we actually think it's in everyone's best interest, the investors and our best interest, to actually have a capital call that's scheduled for the amount of the improvements if the improvements are not going to be done during those first couple months on the property. So again, I think the question is more in the context probably of if we fell short on capital, you do a capital call. But I think in terms of capital call is not always a bad thing. And if you set the expectations up front and you say, listen, this is for every $100,000 invested, we're going to put 90 in now, and you can expect a capital call 6-12 months from now where we're going to need the other 10%, right, of the capital. That can actually be more attractive because the investors can keep their money in the markets or whatever it is that they'd want to collect a return on with that money. And then for us, we're not accumulating preferred return that we then owe to the investors. So, I think in that sense, it actually can be a very attractive model. And then when it comes to a capital call that's unexpected, I think that's where people get frustrated.
Oh, yeah.
And I think that's what you really want to make sure you budget well up front to avoid.
And just to tack on to Dylan's point, I think Dylan raised excellent points. It's about setting investor expectations from day one. So what you can't tell somebody is this is the safest investment in the history of mankind. And then 6 months later, you're doing a capital call. Because that just sends such a mixed message, right? So Dylan said the exact right thing. But the other thing what I wanted to say, and I think Dylan mentioned that, is that a lot of folks, including us, what we do is we will over-raise. So if I have to raise, say, $4 million, I will raise $4.5 or $4.7 million. And this does not include my CapEx. This is just extra money I've raised on top. And I am paying investors a preferred return on it. But this is just to ensure that I have adequate liquidity on hand. Because at the end of the day, what you don't want to be caught is, you're in the middle of the project and it's doing really well, but you just ran out of cash. And now it's not going anywhere. And now you have to do a distress sale.
Omar, I have a question on that. To that point, are you able, you're talking about this as well, are you able to do a return of capital at some point if you get 6 months in and you've raised a certain amount, instead of having it be a return on investment and having that eventually get absorbed through cash flows? Are you able to?
That's dependent on your PPM because it's dependent on what you classify as a capital transaction. Because look, refinance is a capital transaction, sale is obviously a capital transaction, right? So if you put it in your PPM to say, hey, I am going to define that, and again, work with your lawyer because I'm not a lawyer, obviously, to say, look, this is my schedule. So at X number of time, I'm going to return you some version of your capital, say 10% of your capital, dependent on these scenarios. Now that could be a capital transaction, depending on how you worded it, and then it becomes a return off capital and not a return on capital, so then you don't get taxed on that. So especially if you raise more money up front, then you can kind of, once you get past that 6 to 12 month hurdle, right, where you're kind of repositioning, and let's say you raise 500, but you got now 400,000 left because you did a fantastic job. Now you can just quickly return that. So you don't get taxed, your IRR number looks better, your cash on cash number looks better, and investor got their money back faster, so everybody's happy.
Yep. No, that's awesome. Good stuff.
Going back to Dylan's point, I think, real quick, I think the capital call is something that's been around in the institutional alternative investment world for forever, but it's something as seen as a bad word or as a negative thing in this non-institutional, more retail syndication space. And it's something I've been recently getting passionate about because I think it would be a really great thing that would help bring a lot of benefit to this space because it is a far more efficient use of your capital. To Omar's point, while it is very safe to keep $500,000 in a bank account, it's terribly inefficient. And if you can find ways, or leave it up to the investors, if they have their money sitting in a quarterly liquidity hard money loan fund that they know that's going to be called upon, and they can have that drawn down into their fund that they're interested in investing in. I mean, that's kind of the more complex world of portfolio.
Rob, you're right, but the problem is when you're dealing with retail investors, that means you have an extra 2 contracts, and then you've got to start explaining everything. And then when you start doing that, I mean, you've scared off 99% of the investors. But instead, where you do actually say, but because I completely agree with you, I feel it shouldn't be in an account not making any interest. Or, making the 0.0001% interest that you're going to get. And it actually, at the bare minimum, should be put in a money market fund, right? I mean, get something out of it, right? But
no penalty CD.
No penalty CD or some version of that. But when you start explaining this to people, the retail investor is like their mind shuts down.
Right. So we're trying to get there. We're not there yet, but I think it's some good points that Dylan raised.
You're 100% right, though.
I was just going to chime in with a few tips to passive investors to make sure they don't have a capital call, in the sense of an unwanted capital call that they're not expecting. So to Omar's point, make sure that the sponsors are raising adequate working capital. That's the term I use. So that's just the capital above and beyond what's needed for the project to pay the closing costs, the rehab, etc. So make sure there's a buffer in the capital that's being raised. That's number one. Number two, make sure that the cash flow in the early years is adequate. So even if the cash flow, let's say, is 10% over 5 years on average, if it's 2 or 3% in years 1 and 2, that's a good indicator that it's a higher risk deal, because there is little cash flow at the beginning of operations. So just something to look for. If you do see low cash flow in the early years, it's probably a heavy reposition. And then the third thing I wanted to mention is the total increase in income year over year. So it's a pretty quick calculation you can do to see what the income increase is each year that the sponsors are projecting. And if you see something like 10% or more in a single year, that could be an indicator of a high-risk deal. Even if you see 5 or 6%, but for the entire duration of the project, that also means it's maybe not conservatively underwritten. So, just say 5 to 8% years 1 and 2, with maybe 3 or 4% after that. I would say that would be kind of a solid conservative deal. So, working capital, cash flow in the early years, and the percent increase each year after that. 3 easy things to look for as a passive investor to make sure you don't have that capital call.
Well, thank you, Sarah, for those last final thoughts. It was a good way to kind of wrap up the panel topics here in the panel discussion. Thank you, guys, each one of you, guys and gals, for joining us here at the underwriting panel here. I think it was a phenomenal panel. Great discussions going back and forth. Lots of different inputs. Really appreciate you guys joining us.
Appreciate you. Thank you, Dan.
Dan, great being on.
Thanks, everyone.
Thanks, guys.
All right, so that is the end of our panel here for the Multifamily Investor Nation Summit. Final panel topics of the entire summit. So thank each one of you for participating in this. Make sure right now you have a few minutes between now and the next segment. We have about 13 minutes until the next session, which is going to be Neil Bawa. He is going to be covering the 2019 real estate trends update. So make sure you go over and grab something to eat, go take a bathroom break, and also register for the next MFIN Summit, which is just going to nextmfin.com. We already have over 100 people that have already registered for the next one, so make sure you jump in there as well. You can also you can get it for the lowest price we're selling it for ever. So it's $97. We're not going to sell it for any lower than that. And you can also go and register for the VIP. So VIPs get a 50% discount right now, so you can get it for $100 extra. So for $197, you do get the next MFIN Typic and the VIP access. So we're going to take a quick break here, and we will be back.
Thank you, Dan.
Thanks, Dan.